I personally find the stories of traders such as those found in the Market Wizard books such an enjoyable read. Even better are the stories from those that were in the trading trenches long before we had the technology that we do today. Even many of the very popular trading indicators of today were not in use back when many traders were making some serious bank in the markets. The popular MACD, for instance, made its appearance in the 70s, while Bollinger Bands saw the light in the 80s. Now, a lot of what these indicators show was seen by these traders just by looking at a price chart. Now, this is a far cry from traders of today who oftentimes have charts with so many indicators that the price bars are impossible to see. And I find the old-timers quite inspiring, and the trading wisdom they pass along, it's unmatched. Which brings me to Richard Donchian. He started dabbling in trading during the late 1920s, and he lost money during the crash of '29, just like many other people did. The difference was that he didn't just quit. He went on to study technical analysis, where he eventually developed an approach that is in use today called trend following. His system was based on moving averages, but unlike many who dabble in trading today, he had trading rules and guidelines that dictated how he traded. Now, over the next several trading posts, I'm going to highlight some of the guidelines and thoughts that Donchian had that I have found immense guidance from over the years and as I continue to develop as a trader. Some of them you've probably heard of, perhaps tried and discarded, and jumping from concept to concept, that's a plague in this business, and other things that may be new to you. Trading Wisdom from Donchian was published in the early 30s, and they've really stood the test of time. Breaks of trend lines. When trend lines that run counter to the major trend break, these are often great signals to take a position, and they're also often used to exit positions for those that like to trade counter to the major trend. This chart here, it shows the major trend using a trend line, which is to the downside. During a trending move down, we can expect pullbacks against the major direction, and trading pullbacks is a very popular method of trading. These pullbacks can be classified as mini trends inside of the bigger trend. Now the issue becomes, when is the time to enter? Using trend lines that highlight the moves back can show when price violates a smaller term move to resume the major move. Traders may place positions when the break occurs, or by using a smaller time frame, they may wait for a pause, a small range in the price action, and enter their position inside of that. Now, stops are usually placed just outside the extreme of the pullback and just outside of the noise of the market. Trend line crawl. Now, I didn't have a better way to describe this guideline, and it expands upon the trend line breaks that were just covered. But this time, we're getting a heads up that the trend may be about to turn. This is applicable to micro trends all the way to the long-term position trading trends. Price pulled back to the trend line, and to see the trend stay intact, we would expect to see price bounce away from the trend line. In this 1 hour chart, what happens tells a very different story. There's a pullback, there's no strong bullish interest, and price just hugs the trend line. It takes about 3 days, and price is not showing much momentum to the upside as price simply trails up the trend line. Price breaks the trend line with what appears to be momentum, and after a valiant fight, the bulls lose the battle, and not seen on this chart, price just plummets. Now, oftentimes what can happen on the longer term trend lines, especially, is that there are so many stops that are set under every lower high, the stops can cascade when the trend line breaks. When this happens, many people that are caught on the wrong side, and their exiting just adds fuel to the already gassed up price move. The astute trader can make some pretty huge gains in a short span of time when this occurs. Let the profits run, cut the losses. Now, this one is not new for anybody, but many traders do the exact opposite. Being in a profitable trade can be exciting, but oftentimes traders will take the profits without a plan to having an exit strategy. Perhaps it's the fear of losing what was made. Perhaps it's the excitement of turning paper profits into realized gains. Whatever the reason, taking profits outside of a risk reduction strategy or a set exit, it's a big reason why many traders never make a fraction of what the market is willing to give. Adding to the problem is having a trade go against you, and instead of taking action to limit your losses, traders hope the price will return. Now, sometimes it does, and you can exit for a scratch. Oftentimes, it does not, and your predetermined stop loss is forgotten as you hold on only to see your loss become a multiple of what you intended. Now, we know letting winners run is important, and the question is, well, when do you take profits? Now, there are a multitude of ways, including patterns and trailing stops, but you really have to find one that fits you as a trader. The trading systems that NetPicks offers actually comes with predetermined profit exits plus your stop losses. So it really does take the guesswork out of the all-important when to exit question. Now, this is just some of the trading wisdom that I have found really useful from Donchian, and in future posts, I will expand on a few more that I hope you find of interest.